In November 2008, the most trusted investment firm on Wall Street told its clients they had $64.8 billion. The real number, everything that actually existed, sat in one checking account, 234 million. For every $100 on paper, about 36 cents were real. That gap was built by hand, statement by statement, for decades. You know the name, Bernie Madoff. What almost nobody can tell you is how it worked. Every disaster on this channel has a machine that failed. Madoff is different. There was no machine. There was a bank account, and there was a costume. A fraud like that obeys one law. It lives as long as more money walks in than walks out. Hold on to that. It's the entire video. First, the costume. It was a masterpiece. The official story: a kid from Queens saves $5,000 lifeguarding and installing sprinklers, and in 1960 opens his own trading firm. Great story. Also a product. It skips the family money and the father-in-law steering accounting clients his way. Even the humble beginning was curated. The firm, though, was real. A pioneer of electronic trading. A serious share of New York's volume. A founder who chaired NASDAQ. That resume isn't trivia. It's the mechanism. Regulators looked at Madoff and saw a colleague. The rich saw the establishment itself. One floor below all that legitimacy sat a much quieter business, managing money for a select, extremely lucky few. You couldn't apply. You were brought in, vouched for, often at an actual country club. Turning money away was theater. Nothing sells like a closed door. He raised first from the community that trusted him personally. Jewish charities, foundations, families who had known him for decades. Then Wall Street built pipelines into the club. Feeder funds, respectable names gathering billions worldwide and passing them straight through to Madoff. The biggest pipe, a fund called Fairfield Century, carried about $7.2 billion into his hands. And the detail that should have ended it early: he charged the feeders almost nothing. They kept the standard fees for managing nothing and stopped asking questions. So that's what the world saw. Now let's draw it to scale. Build Madoff the way the world believed in him. A cathedral of finance. Upstairs, a real machine. The market-making floor did real trades for real customers and made real money. Gold. Humming. Legitimate. That hum had a job. Every honest trade upstairs pumped credibility into the front. Two businesses, one building. One made money, the other collected it. Now, walk around the back. The cathedral is flat, a stage set, painted columns, a prop rope, nothing behind the paint. Nothing except one box. A checking account at JPMorgan Chase, where every dollar landed and sat. The staff called it the 703. You're waiting for the part where the money goes to work. There is no such part. There was a strategy on paper: split strike conversion. Blue chips, options as floor and ceiling. Real strategy. Professionals run it every day. He never ran it. In the advisory business, nothing was bought at all. For how long? Madoff said the 90s. His deputy said the 80s. One trader's testimony reaches the 70s. Even the start date is missing. And watch the far edge of the diagram. A door from the box toward the market. Nothing ever crosses it. So where did the returns come from? You already know. Everyone knows. New money in, old money out. The same box. A withdrawal was simply the deposit of whoever walked in behind you. The path closes into a ring, spinning one way. And notice what the ring never touches. The market door stays dark. This isn't a strategy that failed. It's plumbing. Plumbing obeys arithmetic. The ring lives exactly as long as more flows in than out. It must always be fed. If you can see how this works, you already understand Madoff better than his regulator did. Subscribe. Next, how he made sure nobody ever checked. Because clients got statements. Gorgeous ones. Confirmations, timestamps, prices, a portfolio breathing exactly the way it should. All manufactured on the 17th floor by a handful of staff and one aging IBM machine printing a parallel universe. Wait for the month to end. Look up what stocks did. Buy last month's winners at last month's prices. on paper after the fact. History is easy to predict once it's already happened. Fresh printouts feel warm, and warm paper asks questions. Statements for auditors chilled in the office refrigerator first. Sheet by sheet, the fiction tiled into a sky. 4,800 accounts, $64.8 billion, existing nowhere but ink. Under the whole sky, the box, unmoved. A universe of paper, balanced on a checking account. The auditor? A storefront firm in a strip mall an hour north of the city. His own family had money in the fund. Now the part that should bother you. All of it was visible from the outside, the whole time, in one picture. Plot the returns Madoff reported. About 1% a month, nearly every month, for 15 years. A smooth line at 45 degrees. 174 months. 7 of them down. His worst month ever, minus 0.55%. Plot the real market underneath. It thrashes. It craters. These two lines cannot be describing the same planet. The smoothness wasn't hiding the fraud. The smoothness was the fraud, published monthly, for anyone who cared to draw the picture. Someone drew the picture. In 1999, a Boston quant named Harry Markopolos was handed Madoff's returns by his bosses. This is the competition. Copy it. The math broke in minutes. At the size Madoff claimed, the strategy needed more put options than existed. Not more than he could afford. More than existed. He went to the SEC in 2000. Again in 2001. In 2005, his memo was titled, "The World's Largest Hedge Fund is a Fraud. 29 Numbered Red Flags." The SEC's own Inspector General later ran the autopsy. 6 substantive complaints across 16 years. 3 examinations, 2 investigations, 0 competent ones. 2 offices once investigated him at the same time without knowing about each other. And they hunted the wrong crime, front-running, because nobody imagined that downstairs there were no trades at all. Nobody made the one phone call to the clearinghouse where real trades leave records. One feeder statement claimed $2.5 billion in blue chips. The record, less than 18 million. Madoff assumed the end had come. He told the Inspector General afterwards, "Monday morning, they'll call DTC and this will be over." And it never happened. In 1992, the SEC had already caught 2 accountants funneling clients to Madoff. Over $441 million from more than 1,000 people. Staff suspected a Ponzi scheme. Then every investor was repaid. The fines totaled $350,000 and the file closed. The repayment money came from the box, the loop paying to keep itself secret. The press asked in print how his numbers were possible. And the smart money quietly knew. Renaissance Technologies red flagged him internally and halved its exposure. Everyone checked. Everyone concluded it was rotten, and everyone protected exactly one party, themselves. So the machine would never be stopped from the outside. It had to starve. In 2008, the entire financial system starved at once. The crisis didn't catch Madoff the way it caught everyone else. His returns stayed perfect. Down markets never touched him. Remember? That perfection killed him. Desperate investors sold what was down and redeemed what was still up. Madoff was the only thing still up. In August 2008, the box held $5.6 billion, its all-time peak. Then, the outflow opened and the inflow died. Nobody had new money. And this machine has exactly one law. By the first week of December, clients had asked for $7 billion back. The box held $234 million. Deposits on one side, withdrawals on the other. The box in the middle. The verdict took arithmetic, not a jury. Madoff told a senior employee he was struggling to find it. Then, on December 9th, he abruptly announced staff bonuses. Months early. On December 10th, 2 senior employees confronted him. The complaint never names them. The world knows them as his sons, who ran the real floor upstairs. He wouldn't talk at the office. At his apartment, Bernie Madoff finally described his business accurately. It's all just one big lie. Basically, a giant Ponzi scheme. A few $100 million remained, and he meant to send it to family, friends, and employees first. The checks were already written. About $173 million. Had the FBI not arrested him the next day, the government wrote, he might well have succeeded. That evening, the family's lawyer called federal authorities. Next morning, 2 FBI agents asked if there was an innocent explanation. There is no innocent explanation. Outside, the facade did what stage sets do. It took the honest business with it. The real trading floor died in the liquidation too. The fraud consumed the only true thing he built. In March 2009, Madoff pleaded guilty to all 11 counts. No plea deal. He insisted he acted alone. That story lasted until investigators reached the 17th floor. His deputy cooperated. 5 staff were convicted on every count. His brother went to prison too. The judge stacked the maximum on every count. 150 years. He called the crime extraordinarily evil. Then the forfeiture order. Read it slowly. $170,799 million. That's not what he stole. It's everything that ever flowed through the box. Real losses, cash in that never came back. About $17.5 billion. 2 weeks after the arrest, a French fund manager who had placed his client's money with Madoff and his own family's took his own life. 2 years to the day after the arrest, his son Mark took his own life. Andrew died of cancer in 2014. Neither was ever charged. A British court called the sons honest men. Madoff died in prison in April 2021, 12 years into the 150. Normally, that's the end. Pennies on the dollar, a lecture about trust. Madoff's ending is stranger. It's why this channel has its name. The money was never invested, so it never burned. It had only been moved from later victims to earlier ones, which let a court-appointed trustee do something no market allows. He grabbed the loop and he cranked it backwards. Everyone who took out more than they put in got a letter. The law calls it a clawback. Here, it's the machine in reverse. One investor's estate alone returned $7,206,157,717. The bank that held the box paid $2.6 billion for never raising the alarm. Crank by crank, over $15 billion recovered, nearly 73 cents of every allowed dollar repaid. Most Ponzi victims get nothing. And the 2 lines get an ending. The paper line simply evaporates. It never existed, so there was nothing to lose. The cash line mostly came home. The unwind was literal. The machine only ever moved money in a circle. The cure was the same circle, run the other way. Don't let the arithmetic comfort you. Nobody caught him. Not the regulator with 6 chances, not the press, not the banks. The machine ran until it starved. The flags were numbered, all 29, on a federal desk 3 years before the end. The lesson was never the flags. The lesson is the costume. The next Madoff won't look like a criminal. He'll look like the establishment. That's the job requirement. Somewhere right now, a line only goes up, and serious people would rather not check what's under it. The check is one phone call. Last time, nobody made it.